I'm starting with a daily chart of the NASDAQ composite. As you know, I like to take a step back and look at the bigger picture. The best traders and investors I've studied throughout history understand where we are within the bigger picture of the market. So going to a weekly chart, I believe we started a new bull market in May of 2023 there. I discussed it extensively on my blog, on television, and in these videos. We had the bear market, just to review, in 2022, and then we bottomed out there, and I talked about this 13-week cup with handle when everything started to set up, and we started to emerge from this, and that's when I believe the bull market started. Some people will say it started on the low of October of 2022. Other people will say it's when you take out the highs. Bottom line is, who really cares? It's subject to interpretation. This is just my interpretation of this. The main point I want you to get from this first segment is bull markets go on for about 3 to 4 years on average. So whether we started a year ago here in May of 23 or October of 22, the whole point is that we're only a year and a half into this, and this has more to go to the upside. When I reset the lines, just as a reminder, when we came out of this and started this bull market here, we ran up, retested the breakout, then had that incredible strength, all the follow-through days, the Zweig breadth thrust. As we approached the highs, we had a handle that's formed. Sometimes you see selling. That's what a cup with handle is when you get near the highs. People who bought here, then you start to see some selling. So we had that shakeout a few weeks ago, 4 weeks ago there, and then we emerged to new highs on very, very strong volume. And the reason I'm bringing this up is that so many people are saying this has gone on for too long. This is getting ridiculous. This is, frothy and so forth. Let's just take a step back and look at the bigger picture. The people who are saying that, in my opinion, are not interpreting things correctly, or two, just have way too negative of a mindset, or three, they're not looking at or three, they're just not really participating. That's why they're so angry at the market. I try to look at things objectively. When you take a step back, in my view, we are just starting to emerge out of those highs from late 2021. The other reason I think the bull market started in May of 2023 is that Jesse Livermore used to say, so goes the leaders, so goes the market. And the leaders will show up as we start new uptrends and so forth. And NVIDIA started to move out of this cup with handle. You can see the big base that was formed with the handle. Guess where that started to move out of its range? Was right in that May of 2023. I've talked about this again extensively on my blog and many different platforms, that bull markets and strong uptrends are usually led by inventions and innovations that revolutionize our lives and change the way we do things throughout history. Railroads, television, airlines, PCs, smartphones, drug discoveries, the internet, the list is endless. In my view, this new bull market is being powered by AI, because what do all those inventions have in common is they help increase productivity. The true leader has been NVIDIA in this, and will continue to be NVIDIA as the true leader in the market. So whether you own it or not, it's worth watching it, because as the leader goes, so goes the market. As far as my near-term opinion with NVIDIA, I've discussed so many times, full disclosure, it's been my largest position. We ran out of this range from 500, ran up, had this shakeout and the base, and with that tightness right above the 50-day. In the past the past 4 quarters, you can't see this because my face is covering the other quarters. NVIDIA's at a run rate of 60 billion. I believe they're going to do about 150 to 200 billion in revenues, get up to that point over the next few years. Jensen Huang's even talked about a $100 billion backlog. So I'm holding my position over earnings. This is not investment advice. I think it's going higher. A lot of the bears will say all of this is priced in. The bulls will say that it's not priced in and it has some more upside left. I'm leaning towards that camp, even if there's some minor hiccup or some inventory concerns, or maybe the market just wants to hold things back until some options expire, as they did back here in November and December. Whatever the case may be, I'll still add to it on the dips, because I still think it's going higher. So when you combine the strong technicals, the strong fundamentals, a lot of sharp money behind this, and also to add on top of this, the insane unusual options activity, not just call activity, but it's been nonstop 10, 20, 40 billion, M with an M, million put writing on this, telling me there's insane demand for this if it dips with put writers that are willing buyers at lower levels. If it goes higher, they still collect the premium if those puts never go into the money. So the unusual options activity is the other reason that I'm still bullish on this position. Now moving on to a weekly chart of the S&P. The other thing is, for people who are saying, we're heading into a recession, we're heading into a bear market and all this stuff. Number one is take a step back. We just had 2 bear markets in the past 4 years. These bear market corrections are not normal every couple of years or so. We had it during COVID in 2020 and when the Fed started raising rates, this 9-month bear market. Again, average bear market's about 9 months, 27%. That's pretty much what we had in average bear market. But we just had 2 of them. So for people who are saying we're heading into a bear market, they're, again, too negative, not participating, or just really, thinking of outside factors. I'm not being, just trying to impose a bullish view on the markets. I'm going by what the charts are telling me, because at the end of the day, the big institutions control the markets. And if they're supporting the markets and the charts, which are broadening out, looks good, I'm going to stick with that. Another thing with recessions is if you're telling me we're heading into a recession, in my view, you're telling me you haven't left your house, because restaurant stocks, fast casual, all that stuff, they're all screaming higher. So people are clearly going out. You got to remember, even though prices are up, wages are up. So people are spending money. Also, I just look around at my screen, something like Royal Caribbean, when you look at a weekly chart, moving out of its COVID high, with cruise lines, and with race, something like Ferrari that's near new highs. These things wouldn't be near highs if we were heading into a recession. Again, just my humble opinion. Going back to the S&P, I want to make a point here very, very clear, because you're probably saying, calm down, Joe, you're being way too bullish. Are we going straight up? Absolutely not. The average intra-year correction is about 14%. I discussed this in my 2 2024 preview videos, which are also posted on my YouTube channel. I just expect, based on the precedent, based on the technicals, based on my interpretation, that the average intra-year correction is 14%. I'm not expecting much more than 3 to 7% this year. So we started this year very, very strong, and then we had a normal 5% or so correction in the S&P before the market regained its footing and is heading higher. And again, surprise, surprise, we are likely later this year to have continued pullbacks, but I don't expect them to be anything drastic, and I just expect them to be shallow pullbacks, normal pullbacks along the way. So again, we're still going to have pullbacks, shakeouts, and normal corrections along the way. How you handle it depends on how your portfolio is constructed, but you either get those stronger entry points if you have a longer term time frame and just deal with volatility, deal with normal pullbacks if you have a longer term time frame, or if you're tactical, nothing wrong with taking profits into strength and having some cash for the inevitable pullbacks. I'll leave that up to you. As far as sentiment, I want to address sentiment. When we do pull back during these times, I don't know what the reason is, whether it's because everybody is just on social media, financial news, everyone spreading negative stuff, bloggers looking for clicks, whatever the reason, there's so much negativity out there that when we just have a normal pullback, maybe it's because everyone's too levered and trading a lot of weekly options and zero DTE, whatever the case may be, these normal pullbacks are causing extreme bearish sentiment very, very quickly. I think from a contrarian point of view, that's great. When you have normal pullbacks and everyone's rushing for the exits and calling for a crash, that is the what's keeping us, climbing the wall of worry, so to speak. The other thing I want to address really quick is sector rotation. A lot of people are saying, what does it mean when all this sector rotation is happening? I think it's great. I think that's a hallmark of a bull market. I'm noticing on my screens, housing stocks rotating into that. I mentioned casual, restaurants, retail, financials. A lot of them are looking good. I think that's good. It's not just tech. It's broad-based. I think that's healthy for the overall market. And I want to reiterate, that doesn't mean I'm being complacent. It doesn't mean I don't stick to stops. It doesn't mean I'm not going to respect the market on any sort of when things and positions turn against me. But I'm also not going to live in fear because I know these types of opportunities don't come around too often. I just want to take advantage of it. So I encourage people, shut out the noise, shut out the news. If it bothers you too much or if social media bothers you too much, then learn to shut that out and pay attention more to what the charts are telling us. One final note about biotech, just because it's not just AI, tech, and so forth, is that mega cap pharma, your Mercks, your Pfizers, your Glaxos, your Bristol Myers, Eli Lilly, you know all the names. Those 10 or 12 mega cap pharma, they're expected to produce over $1 trillion with a T in free cash flow over the next 4 to 5 years. Merck alone is expected to generate over $100 billion in free cash flow over the next 4 to 5 years. What does that mean? Tons of M&A, as a lot of these established big pharma companies will look to build their pipelines with continued M&A and continued opportunities. And not just M&A, but drug discoveries. You know, we were in CYTK in the 30s and Viking in the 20s and MGNX around $10. And a lot of these were up 100 to 400%. Yes, some of them have pulled back. The whole point, though, is when you're getting a double or more in some of these, I can't help you if you're not taking profits. I've made it very clear that I've taken a lot of profits in some of these names. I also think there are more names coming up that I'm going to do my best through my resources, through unusual options activity, to interpret the best that I can, and I'll mention some later in this video. But the bottom line is this is becoming more broad-based, and between IBB, which is one of the main biotech ETFs, and XBI, I still think there's going to be opportunities in this sector as well as with some individual names. So let's get into the next segment.